First of all, I want to agree with Michael. I think we're going to get through 50, and I think we're going to look at it in the dust at some point. But to be consistent, I have said over and over, as you know, that I thought we might stall out at 50 because it's such a psychological barrier. And we saw one increase in margin requirements. And I noted that. I think I retweeted it to Craig, if I remember correctly. And this is what they do. I mean, they keep increasing margin requirements until, you got to put up basically the cash cost for the commodity. And then you see the market fall off. We're getting that direction. I'm not surprised. I got let's say, I won't say angry, but a agitated member this morning. First thing I get up, I haven't even had my coffee. What the hell's wrong, David? Silver is at 51 and every one of my stocks is down. What I said was, look, normally the shares lead the metal. And this is the pros taking profits in the shares and selling it off. And it's like they get the memo ahead of everybody else. So I don't want to put on the foil hat too much. There are times where these markets do what they do because of the setup. And this is one of those moments. And I do want to show a chart later on, Elijah, but I just want to hand it over to my colleagues and hear them. And I'm not making this an I'm a right and, whatever, because I want to see a couple more days of trading. But I'm not shocked that we hit that magic number and all of a sudden the big sell-off. So I'll leave it at that. Thank you.
Yeah, well, in the futures, we watch the front month contract. Now, I know spot is above the front month contract. And it got to 51 and dropped back under 50 slightly. So it made new highs. Futures did not. They stopped at 49.76, a couple cents below $50. So some guy said, I'm going to sell the nearby future just below 50 and risk a nickel. Okay, make a dime. Okay, well, they're getting a sell-off here. Fine. Okay, I think it's idiot selling. Our assessment technically is that silver is about to make a quantum leap to a new reality. It's not in a bull trend. It's in a total shift phase in its price zone that it's lived in for 50 years. 50 highs, basically 20 is sort of a low, and it just lived there forever. Go to the Federal Reserve of St. Louis, Fred, and you can punch up charts like lead or zinc, and go back in price history, and they'll have monthly close-only chart going back to the 1990s anyway. And you'll see that they lived in a zone for quite a few, decade and a half or so, both those base metals. And in 2006, very late that year, silver and gold were already in a bull trend at that point. These metals took off and tripled in value, base metals. And since then, they've come back down, but they've never come back down into that prior zone of reality. They live in a new zone of reality that is double or more on average for the last 10, 15 years of what it used to be back in the 1990s to 2000. Well, silver's still in that first range, okay, where it was from the 1979-80 high, the 2011 high. Gold's above the 2011 high, copper's above the 2011 high, and silver's still contained here? Give me a break. Okay, we know the fundamentals. I don't try to keep up with them too intimately because that's not what we do. But the technicals argue to us that we're about to blast out of this range and not just have another nice leg up, but move into a price zone of new reality. I'm betting it's well over 100. It may be between 100 and 200. And I think a lot of that's going to occur in a handful of months, 5 to 6 months. We're waiting on one trigger. That's a spread relationship between gold and silver. And we run momentum studies of it as well. Now, everybody looks at the ratio, the 80, 70 to 1 type thing. We do it a different way. We divide silver to gold, express it as a percent. And right now, silver is about 1.2% of the price of an ounce of gold. That's extremely low going back 50 years. It's been over 2% in 21 of the past 50 years. Silver has reached 2% of the price of gold. And some of those weren't even bull market years. Okay, so we're very submerged, but there is a very clear structure on the spread charts. When you plot the spread chart, silver versus gold, there is a pending triple top breakout at 1.31%. So we're not far below there. When we cross that level, the same thing happened to its spread versus gold in 1979 and in the fall of 2010. Just before silver went totally vertical, it went from like 20-something bucks to 50, boom, all in a handful of months. The spread was the tell, and we're watching that. We think it's going to break through. And our momentum of the spread suggested even a lower level than that 1.31%, which is a prior double top, will break out before that. And when we do, when that spread breaks out, I'm putting the seatbelt on. I think silver is the place to be for the next 2 quarters, and the move could be enormous. And you look back and say, oh, now I understand why. Supply demand's been tight, et cetera, et cetera. Market has been an irrational level for too long compared to other metals, for example, that have done the same thing, had a tantrum and moved to a new reality. Anyway, that's my major comment.
All right, folks, let's get right to it because silver's doing what silver does best, making everyone nervous right before it makes them rich. Michael and I have been saying for months that once we break $50, the psychological dam bursts, and now here we are, staring at that number again like it's Mount Everest. We've climbed this mountain before, 1980, 2011, and both times the view up there was spectacular before the avalanche came down. But this time feels different. You see, $50 isn't just a number, it's a mythological barrier. The market treats it like it's guarded by dragons and Federal Reserve wizards. And sure enough, the moment we poked our heads above it, the CME came riding in with their favorite trick. Raising margin requirements, that's code for we're scared. When exchanges jack up the cost of holding futures contracts, they're not just managing risk, they're controlling panic. Because if traders need to put up more cash, a lot of them simply can't, and that forces selling. Boom, instant price drop. I woke up this morning to messages from people who were half panicked, half accusing me of witchcraft. David, silver's $51. Why are all my mining stocks down? Look, I get it. You expect the miners to lead the metal. Normally they do, but what we saw was professional selling, not panic, not manipulation, though that word gets thrown around a lot, but simple profit-taking. The big players took chips off the table while everyone else was still ordering another round. This kind of shakeout is normal at breakout levels. Think of it as the market's way of asking, are you sure? And trust me, we are. See, the real story here isn't the day-to-day noise. It's the structural setup. Silver has lived in the same price range for half a century. Ever since the Hunt brothers' 1980 spike in the Echo Rally in 2011, it's been trapped in a zone between $20 and $50. That's like being stuck in the same apartment for 50 years while the neighborhood around you gentrifies, inflates, and changes currencies 3 times. Meanwhile, look at copper, zinc, lead. Even those humble base metals broke free of their old zones long ago. They tripled from their early 2000 levels and never looked back. Silver's the last one still living in the basement. But here's the key. Markets don't stay irrational forever. They eventually reset to a new reality. When they do, the move isn't gradual, it's violent. I think we're about to see that kind of breakout in silver. Not just another rally, but a quantum leap into a new pricing universe. I'm talking triple digits, folks. $100, $150, maybe even $200 an ounce over the next 6 to 12 months. And before anyone rolls their eyes, remember this. Gold has already broken out of its 2011 highs. Copper's way above its old records. Silver is the only major metal still lagging behind. That's not a coincidence, it's an opportunity. Now let's talk psychology for a second, because markets aren't just math, they're emotion. Every trader, every algorithm, every analyst looks at $50 silver and feels something. For some, it's excitement. For others, it's fear. And that's exactly what makes it powerful. Every time we've approached $50, the market's gone through the same ritual. Prices surge, media coverage explodes, margin calls hit, and weak hands fold. The strong hands, the ones who actually take delivery, who own physical silver, who understand that fiat money is just a promise written on sand, they sit tight. And that's who this conversation is really for. Not the day traders, not the ETF speculators, but the people who actually own silver. Because once this thing breaks free, there won't be time to get positioned. The revaluation will happen fast. Now, Michael's been running some very interesting technical models, the kind that make most chartists sweat. He's not looking at ratios the way most people do. You know how the media likes to say the gold to silver ratio is 80 to 1? Well, Michael flips it. He divides silver by gold and expresses it as a percentage. Right now, silver's only about 1.2% of the price of gold. Historically, in 21 of the past 50 years, that figure has hit or exceeded 2%. In bull markets like 1979 and 2010, it went way above that. And every single time it meant silver was about to explode. Right now, that ratio is forming what Michael calls a triple top breakout. Once it crosses 1.31%, all bets are off. The last time this setup appeared was 1979, right before silver rocketed from $10 to $50 in a few months. The next time, 2010, just before it jumped from $20 to $49. History doesn't repeat, but it rhymes like a Dr. Seuss book.
So this is a chart from Matt Watson. He's an analyst that does all the metals across the board based to exotics like iridium, which I know almost nothing about. So this is a chart showing silver demand, what he calls the low case. And the red line is all silver production, which means the black line, which is the mining. And the red line is mining plus recycling. And what you see from 2024 onward is that basically we're in a deficit situation based on industrial demand alone, and that we've been in a deficit for the last 4 years or thereabouts. Now, that's what Jim Dines used to call a natural corner. We've all heard about, ad nauseum, the hunts try to corner the market and all that. Well, what Dines said is there'll be a time where the market forces for industrial use only will corner the market. In other words, we won't be able to mine and recycle enough to meet the demand. Well, that's what this chart shows. Now, where I disagree with Matt honorably is the silver or gray bar on there shows investment demand. That investment demand is roughly 200 million ounces consistently from 2025 to 2050 for the next 25 years. Well, no one knows the future, but I contend that as we move into this paradigm, which is one of my main themes from day one when I learned about honest money, is that you can't print your way out of this mess, which means more and more people are going to be seeking real truth, which means real money. So those gray bars, you could double and triple them. And not to be too nitpicky, but the line at 2020 shows 200 million. That is incorrect. It should be up here where, if you can see my cursor, at about 1.25, because in that year alone, the demand for silver in quote unquote physical terms was 320 million by the ETPs, and the normal 200 million by retail, for like 520 million ounces in that 1 year on investment demand. So if we can do that in 2020, we can do it in 2025. So I think this situation is, Michael and Craig have said, and many of us, that we're getting into a new paradigm. I don't like to use that lightly, and I think Michael said it best. I mean, we're in a situation where reality is going to shine through on all the naysayers like they can't believe it. I mean, we get through 60, 70, people are going to be doing the one-handed salute going, oh, I hated Morgan, or he's an idiot, and oh my God, look what's happening now. I don't have too many detractors on X right now. I'll put it there. I'll give it back to you. I'll quit sharing the screen. But and that's the low case spot. If things go higher for AI or EVs or what have you, it'd be beyond that.
Yeah, that reality's been there for a while. We know that. Recent years where the supply demand is the way it is and demand increasing, supply is not, et cetera. And yet price hasn't responded in a real way. I mean, you think about dollar terms also. 1980, $50. In real dollar terms, where would it put us now? It's probably 250, okay? In the decay in the value of the US dollar, not relative to other currencies, but in real buying power.
Michael likes to say that markets don't just change trends, they change realities. And that's exactly what's happening right now with silver. Let's step back and look at the big picture. For 50 years, silver's been stuck in a time warp. From the Hunt Brothers mania in 1980 to the post-2008 rebound in 2011, every big rally hit the same ceiling, $50. It's like the market's been hypnotized by that number. But numbers are only powerful until they're broken. Once $50 becomes support instead of resistance, the psychology flips forever. And that's what I mean by new reality. It's not about silver just being up. It's about silver finally repricing to reflect 50 years of monetary abuse, inflation, and paper dilution. Let's remember what's changed since 1980. Back then, the U.S. national debt was $900 billion. Today, it's over $36 trillion. Back then, the Fed's balance sheet was a rounding error. Today, it's $8 trillion and counting. Back then, a loaf of bread cost 50 cents. Today, it's $5. Yet silver's price is the same? Come on. That's not equilibrium. That's distortion. And distortions eventually correct themselves. Now, some people still think silver's just another commodity, like copper or nickel. It's not. It's monetary metal. It's the poor man's gold, the people's hedge against financial tyranny. That's why governments and banks hate it. You can't easily financialize physical silver. It's too bulky, too real. So instead, they use the futures market, a paper-silver universe where a handful of traders control prices for a metal they don't actually possess. And here's where the fun begins. Because when you raise margin requirements, when you create artificial volatility, you're not changing the fundamentals. You're just shaking out the weak holders. The metal doesn't vanish. The demand doesn't vanish. It just transfers ownership from the impatient to the prepared. This is why every serious analyst I know, from Keith Neumeyer to Rick Rule, has said the same thing. Silver is the most undervalued major asset on Earth. And that's not just rhetoric, it's math. Let me give you one example. The total annual global silver production is around 800 million ounces. At $50 an ounce, that's $40 billion worth. For context, Apple's cash reserves are roughly $60 billion. That means one company could, in theory, buy every ounce of silver mined this year and still have money left over. That's how small the silver market is. Now imagine what happens when trillions of dollars start looking for a home outside the dollar system. When central banks, sovereign funds, and private wealth begin diversifying not just into gold, but into silver. The revaluation won't be linear. It'll be exponential. Michael's technical models tell us the same thing from another angle. The silver to gold spread, that 1.31% level, is like a coiled spring. Once it snaps, silver doesn't just rise, it redefines its relationship to gold. It's the same signal that preceded both the 1980 and 2011 surges. And let's not forget the industrial side. In 1980, silver was mostly monetary. Today, over half of all silver demand comes from industry. Solar panels, electric vehicles, electronics, even medicine. Once silver becomes both a critical industrial input and a monetary refuge, you've got a perfect storm. We're already seeing it. Lease rates for silver, the interest rate to borrow physical metal, have spiked as high as 20 to 30% for short-term contracts in London. That's not normal. That's what a short squeeze looks like. People are scrambling to find physical metal to cover obligations. Meanwhile, the ETFs claim to have hundreds of millions of ounces in vaults. But good luck verifying that. Some of those bars might as well be Schrodinger's silver, simultaneously there and not there until someone audits them. And while paper traders argue over fractions of a cent, real-world buyers are paying $60, $70, even $80 an ounce for physical bullion. That's not a premium. That's the real market finally diverging from the paper illusion. So yes, I think Michael's right. When this breakout happens, we'll see a quantum shift. Silver will move from the old $20 to $50 range to a new zone, maybe $100 to $200. It'll take months, not years. And when it happens, most people won't even believe it. They'll say it's a bubble, the same way they said that in 1979, the same way they said it in 2011. But what they'll miss is that this isn't speculation, it's revaluation. Let me tell you a story. Back in 2008, when Lehman collapsed, I was sitting with a group of fund managers who were convinced the Fed would contain the contagion. They thought the system was too sophisticated to fail. Within 6 months, those same people were buying physical gold for the first time in their lives. That's how fast psychology changes. When the next credit shock hits, and it will, the same shift will happen with silver. People will move from ETFs and futures into physical. The squeeze will go global. And by the time CNBC starts running, "What's happening to silver?" your segments, The train will already have left the station. So what should you do? You prepare, you accumulate, you hold, and above all, you understand why you're holding. Silver isn't just a trade, it's a statement. It's an act of financial rebellion in a world addicted to debt and delusion. It's owning something real in a system built on promises. And one last thing, don't get shaken out by volatility. The next few months will be wild. You'll see silver crashes, $5 overnight, headlines. Ignore them. That's just the system trying to protect itself. Because deep down, they know what we know, that $50 is just the beginning. When silver hits triple digits, when the paper markets finally break, people will look back on this moment, this very conversation, and say, that's when it started to make sense. And if you're holding physical, if you're patient, if you've tuned out the noise, that's when your patience pays off. So buckle up. The seatbelt light is on. Turbulence ahead, but the destination is freedom.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.